During times of market turmoil, a thought flashes across the mind. How does it end? Well, given that nothing new ever happens in the markets, it mostly ends in the same way. After a period of incessant selling, tiredness and exhaustion sets in. The sellers really have nothing left to sell. The bout of selling also results in mispricing of many stocks, and as a result, buying interest resumes. This is augmented by the fact that during periods of market declines, short sellers join the bandwagon. And once the move is complete, and with the need to protect their gains, they become increasingly nervous with a need to buy back the stocks. This adds to the buying impetus. If you look at the market trajectory during the classical bear markets of 2000-2002 or the bear market of 2008, you will find that the market falls are interrupted by some very sharp rises. Even during the worst possible times and in the midst of the bear market, or shall we say the depths of the bear markets, the markets can rise sharply, as was the case in the immediate aftermath of 9/11 in 2001 or the Mumbai terrorist attacks in 2008. These rallies are called bear market rallies, and they occur quite consistently, irrespective of whether the bear market has just started, is in full swing, or is nearing the end. In the case of the more garden variety corrections, also this happens, and you will rarely find that the markets fall for a consecutive period of 2 to 3 months or more. May has been a brutal month so far, and if it ends down, then it would be the second down month in succession. It is very unusual for there to be 3 down months in succession, and an inspection of Nifty returns since 2015 will show that there have only been 2 instances when the markets fell 3 months in a row. The first was from December 18 to February 19, when the Nifty fell on each of these months, but the cumulative fall was shallow. In the immediately 2 succeeding months, the Nifty rose about 9%. The other instance where the Nifty fell 3 months in a row was from June 19th through to August 19th, and cumulatively the markets fell 8%. But in this instance also, the markets pulled back sharply in the next 2 months and recovered all the losses. Barring these 2, there have been 10 other instances during this period where the markets have fallen 2 months in a row. Barring one instance, the recovery in the 2 months immediately following the decline was sharp. You just have to look at the table to see the last 10 instances when the markets fell 2 months in a row. In fact, the last of them was not very long ago, between January and February of this year, and as you will remember, March was a month where the markets again rose very sharply. Based on this, it is fair to say that if May ends in a decline, the next month, which is June, may see what is called a sharp pullback. Of course, what happens after that is anybody's guess. If it is indeed a bear market, the selling may again resume. But you never know, we might get lucky and this could be the bottom for the year. Are these moves tradable? Yes, they are. Provided you can create structures for the trade by framing rules, doing the right position sizing, and having strict stop losses.